On the last Friday of June, in a single closing auction, about $334 billion of stock changed hands in under 2 seconds. It was a record and one of the busiest moments of the entire trading year. There was no panic, no crash, no breaking news, just a date on the calendar that thousands of funds are forced to trade around. This is Index Rebalance Day, and once you see how it works, you will never look at a quiet Friday in June the same way again. Here is why a calendar date can move billions. Trillions of dollars now sit in index funds that promise to hold exactly what the index holds. About $12.2 trillion is benchmarked to the Russell family of United States indexes alone, and roughly $20 trillion to the S&P 500. When the index changes its membership, those funds do not get to have an opinion. They must buy what is added and sell what is removed, in size, on the day it takes effect. That forced, price-insensitive demand is completely predictable, and anything predictable in markets attracts a crowd that trades ahead of it. So the passive giant and the active opportunist meet on one date. Let's set the stage. Every year, FTSE Russell rebuilds its United States indexes from scratch. It re-ranks the market by size and reshuffles thousands of stocks between the large-cap Russell 1000 and the small-cap Russell 2000. For decades, this happened once a year, on the last Friday of June, in a single enormous rebalancing. Starting in 2026, Russell moved to twice a year, adding a December date to spread the load. The S&P 500 does its own version every quarter. Each of these is a known date, published far in advance, so the whole market can see the wave coming. The question is what happens when it lands. Now watch the machine turn. Step 1. The index provider announces the changes in advance, which stocks join, which leave, and the new weights. Step 2. Every fund that tracks the index now has a problem. To keep near zero tracking error, it must match the new index precisely, and it wants to trade at the exact closing price used to set the index level. Step 3. That pushes an enormous amount of buying and selling into the closing auction on effective day, which is why one auction can print hundreds of billions of dollars. Step 4. Because the direction and rough size are knowable ahead of time, other traders position early, providing liquidity and taking the other side for a price. The result is a predictable tide of flow that has almost nothing to do with any company's fundamentals. It is mechanics, not opinion. This is not abstract. When the S&P 500 announced that Palantir and Dell would join in September 2024, the shares jumped about 8.5% and almost 9% on the news, before a single index fund had bought a share, purely because the market knew the forced buying was coming. When Coinbase was added in May 2025, its stock rose around 8%. And one estimate put the forced index buying at roughly $16 billion. But here is the twist. As more money went passive, this edge started to fade. A widely cited study found the average pop from joining the S&P 500 shrank from about 7.4% in the 1990s to roughly 0 in the last decade, because so many traders now crowd the same predictable trade that they compete the profit away. So here is the lens to keep. Index rebalance days are one of the few moments when you know, in advance, that huge amounts of money must trade in a known direction, on a known date, regardless of price. That is the purest example of flows moving markets rather than fundamentals. But it also shows the second law of markets. Once a predictable edge is widely known, the crowd piles in and the edge erodes. The inclusion pop that was once large is now close to zero. Forced flows still move prices in the moment. Whether anyone profits from them depends on how many others saw the same calendar. This channel explains how markets work. It is educational, not financial advice.